Welcome back to The Explainer. Today we're diving straight into a massive contradiction happening right now in the AI infrastructure boom. I mean, we hear every single day about the unstoppable rise of artificial intelligence, right? But if you take a step back and really look closely at the physical infrastructure actually building it, a fascinating paradox starts to emerge. See, the narrative of infinite growth doesn't always match the economic reality on the ground. So today, we're going to explore this tension. We'll start by looking at one highly specific company, and then we'll zoom way out to examine a compelling macroeconomic theory that suggests this entire industry-wide build-out might just be a bubble waiting to pop. Let's get into it. So let's start with the mystery of Fabrinet. This is a company that recently reported a staggering, record-breaking fiscal year 2026 revenue of $4.6 billion. Management was openly hyping up accelerating demand on their earnings call, and honestly, by all traditional metrics, they absolutely knocked it out of the park. And yet, almost immediately after those stellar numbers came out, the stock suffered a sudden, brutal one-week decline of nearly 30%. I mean, think about that. When a company posts billions in record revenue and then its valuation just falls off a cliff days later, you really have to ask yourself, what exactly are investors seeing that the headline numbers are hiding? There is just an incredible contrast hiding in the data here. On one hand, you have the fourth quarter reality. We're talking an absolute blockbuster 45% year-over-year revenue growth. That's the kind of top-line momentum that most tech companies would literally do anything to achieve. But on the other hand, you have a 29.64% drop in the stock price in just a single week. The market essentially wiped out nearly a third of the company's value in a matter of days. Has Wall Street found some fatal flaw hiding underneath this incredible pattern of growth? Well, to figure that out, we first need to understand what this company actually does and how exactly it fits into the broader AI picture. Now, Fabrinet isn't exactly a household name, right? You're definitely not going to see their logo stamped on the front of a gleaming new AI server. Instead, they operate entirely behind the scenes. They provide advanced optical packaging and precision manufacturing for the massive AI data center supply chain. Basically, the biggest tech companies in the world design these incredibly complex AI processors, and Fabrinet acts as the silent partner that manufactures the critical optical components needed to make those processors talk to each other. Without their highly specialized precision, the data simply doesn't move. And let me tell you, those optical components are absolutely vital right now. Training huge AI models with trillions of parameters requires staggering amounts of data moving between thousands of graphics processing units, what the industry likes to call east-west traffic. Now, this isn't just a software update. We're talking about a massive physical hardware shift from 800G to 1.6T optical modules, just to prevent catastrophic data traffic jams. Because the faster the AI gets, the faster the hardware connecting it needs to be. Fabrinet sits right smack in the middle of this incredibly demanding high-speed supply chain, so the revenue is very real and the technology is undeniably essential. But here is where we find the real smoking gun, and it comes down to a single metric. Despite those billions of dollars in revenue flowing in, Fabrinet's non-GAAP free cash flow for the entire fiscal year 2026 was, wait for it, only $4.2 million. Yeah, you heard that right. Over $4.5 billion in revenue, but only $4.2 million in free cash flow. When you contrast the sheer volume of money moving through the company with the tiny, tiny sliver of actual cash left over at the end of the year, it completely flips the script and instantly explains the market's sudden panic. This core contradiction really comes down to how capital is being deployed. Fabrinet generated an incredibly healthy $256.7 million in operating cash, which shows the core business is definitely working. But then they immediately turned around and spent $252.5 million of it on capital expenditure, specifically property, plant, and equipment, just to build out future capacity. In other words, they essentially spent every single dime they made just to prepare for tomorrow's AI demand. The money came in the front door and went straight out the back to buy more factories and equipment. So this leaves us with a pretty critical question. Is this exceptionally weak free cash flow a major warning sign that the business model is struggling to generate actual cash for its shareholders? Or is it simply the required, painful cost of building the infrastructure needed to keep pace with this massive AI boom? Well, to figure that out, we have to transition away from Fabrinet's specific cash flow problem and investigate the entire AI infrastructure sector on a macro level. We need to see if this is just an isolated incident or a symptom of a much, much larger trend. To do that, let's zoom way out, using a recent academic paper by Douglas C. Yuvan. Now, this paper makes a fascinating and honestly highly controversial argument.
It suggests that this massive physical AI build-out, these sprawling gigawatt data centers and mountains of specialized processors, is actually a late-stage macroeconomic bubble. The paper argues that the industry is currently engaged in a historically massive build-out that is driven entirely by speculative demand forecasts, rather than validated real-world market utility.
Right at the heart of this bubble theory is a concept called the revenue gap. Basically, this is the widening gulf between the hundreds of billions of dollars being deployed for AI hardware and the relatively small actual revenue being generated by AI software subscriptions and API access. Right now, the industry is operating at massive structural losses. They are essentially subsidizing the cost of compute to encourage adoption, kind of just hoping that a miraculous explosion in enterprise spending will eventually bail them out. It is an incredibly high-stakes game of chicken with hundreds of billions of dollars on the line. The paper draws a sharp contrast between the tech giant's illusion of infinite demand and the brutal physical reality of real-world constraints. See, hyperscalers are out there projecting that every single company is going to need continuous exponential AI processing power forever. But in reality, constructing these AI factories requires highly specialized liquid cooling technology, gigawatt power grids that literally take years to connect, and a specialized workforce that is currently stretched to its absolute breaking point. It's this incredibly rigid, expensive, and slow physical reality colliding head-on with wildly optimistic software projections. And this collision with physical reality, it sets the stage for a terrifying historical parallel. The source material maps today's synchronized rush to build these AI gigawatt campuses directly onto the late 90s fiber optic glut. Think back to that time. Telecom giants poured hundreds of billions of dollars into laying global networks of fiber optic cables, absolutely convinced that internet traffic would just scale indefinitely without any interruption. But infrastructural supply rapidly outstripped commercial demand, and we all know what happened next. It led to a massive, devastating crash. When the dot-com bubble finally burst, the telecom industry was left with networks where 95% of the installed fiber optic capacity was completely unused. They literally called it dark fiber. Well, the paper warns of a looming equivalent for the 2020s, idle compute. We're talking about heavily financed gigawatt-scale AI data centers, absolutely packed with rapidly depreciating, highly specialized silicon just sitting partially empty. Why? Because the enterprise software demand simply didn't materialize at the massive scale that everyone projected. So how exactly would an AI bust unfold? The paper outlines a specific, highly logical chain of events. First up, utilization rates collapse as everyday enterprises realize the return on investment for AI is just lower than expected. Next, the hyperscalers, now under intense shareholder pressure, execute sudden and absolute capital expenditure pullbacks. Finally, this triggers refinancing crises for special-purpose vehicles. Now, these are the off-balance sheet shadow debt structures that tech giants use to finance these massive data centers quietly. If those leases aren't renewed, these heavily leveraged vehicles will suddenly default, completely pulling the rug out from under the market. And if that happens, we're looking at a cascading contagion. It's not just tech stocks that suffer here. We would see sudden labor deflation for the highly specialized tradespeople who flocked to build these massive data centers. We'd see stranded utility assets, where power companies spent billions building new plants for data centers that were suddenly abandoned. And we'd see a massive inventory shock ripple backward through the entire highly concentrated semiconductor supply chain, impacting literally every single component manufacturer along the way. Honestly, the driving force behind this entire infrastructure race is essentially a fear of missing out. Good old-fashioned FOMO. Companies are terrified of competitive exclusion, meaning they're overbuilding today just to ensure they aren't left behind tomorrow. This panic artificially inflates the cost of everything, from cooling plans to optical cables, and completely divorces capital allocation from actual validated economic demand. As the paper points out, it has all the classic characteristics of a late-stage economic bubble. Which brings us right back full circle. Let's take this macroeconomic theory back down to our initial micro case study just to see how all the puzzle pieces fit together. If this AI infrastructure bubble does eventually burst, or hey, even if capital expenditure simply slows down to more normal historical levels, what exactly happens to a company like Fabrinet, a company that has been aggressively spending every single dollar it makes to expand its capacity for a future that might not even arrive? When weighing all these factors from the source analysis, the final verdict for Fabrinet is a definitive watch. Now, the underlying business is objectively strong, no doubt about it. Revenue and earnings growth are excellent, and their position in the supply chain is vital. But their capital spending is very high, making free cash flow a major watch point. If their massive investments actually generate years of higher revenue, today's spending looks absolutely brilliant. But if AI demand normalizes before that new capacity actually earns a return, those economics change dramatically. It requires extreme patience and keeping a very close eye on those macro trends. I want to leave you with a final question to really chew on. Think about the broader AI market and the countless companies currently fueling it. If this infrastructure bubble pops, or even just deflates a little bit back to historical norms, are the valuations you're looking at built on actual current free cash flow, or are they entirely dependent on the illusion of infinite, uninterrupted demand? It's a vital question for anyone trying to navigate this incredible, yet highly volatile, technological shift.